All right, so this is Jon Johnson, a mortgage loan originator, coming at you with a video that I can be able to do a hour presentation on, which is the future of rates this year. But I'm going to keep this to just a couple of minutes so you can understand the most important thing that's going to be affecting rates. The Federal Reserve has a big thing to do with that. They plan to increase the Fed funds rate. That's going to affect rates a little bit more on short-term rates rather than mortgage, but it will affect rates a little bit. You also have mortgage-backed securities. The Federal Reserve, they own a ton of these mortgage-backed securities. So they plan to be able to, they plan to start offloading those. They plan to start selling those. That's going to affect rates. War, Russia, Ukraine, things that come out of that, those can affect rates, or any other type of news can potentially affect their rates. But this is going to be the main item that's going to be affecting rates this year is going to be inflation. So the Federal Reserve, the people that run, pretty much all the banking in America, their main job is to keep inflation under control. They want it at a moderate level, somewhere around 3 to 4%. They don't want inflation to be too crazy low. They don't want it to be too crazy high. They want year over year for it to be at a moderate percent. And over the past 20, 30 years, there's been a couple different times where inflation has gone up a lot more than that. And that's because inflation has gone up a lot where it is right now. For example, when Burns and Volcker were the Fed chairs, inflation was at 7% to 14%. It went up from 7% to 14%. Inflation will always cause mortgage rates to go up. And that's a whole nother presentation as well. But just understand that when inflation happens, it's very dire to the steadiness of an economy. That means that it's going to cost a lot more for your average goods, whether that's going to be gas, whether that's going to be when you go to the grocery store. The things that people depend on is going to go up, which causes a lot of things to go bad in an economy. But just understand that, for example, when Burns, Volcker, they were Fed chair, inflation went from 7% to 14%. Mortgage rates went from 12 to 18%. So what does the Fed do? They increase their funds rate to try to counteract that. And it does work. So they increase it from 11% to 20%. This is how much banks are able to get money from them, which in turn ends up being how high your interest rates will end up being when you try to purchase a car, try to get a personal loan, things of that nature. Those are going to be a little bit higher than what the bank initially got their loan from the Fed. So if a bank has to get a loan from the Fed with a 15% rate, they could put for a car 19, 20% interest rate on that car to make sure that they're getting a profit on it. So in this situation, they increase, with that first example, they increase their rate from 11 to 20%. Inflation then went down from 14 to 5%. Mortgage rates end up coming down as well from 18 to 12%. So understand when they do that, when they counteract inflation by increasing the Fed funds rate, mortgage rates inevitably end up coming down a little bit. But it always leads to recession, or almost always. So S&P went down 30% when they did that. And that's because to the Federal Reserve, they want to try to counteract recessions happening, but taking care of inflation is the #1 priority for them. And by the way, this is all information I got from Barry Abebe in one of his presentations, MBS Highway. He does a great job on all of his presentations. Anytime you get a chance to listen to him on mortgage or housing, it's always going to be good stuff. So in the middle is Alan Greenspan. I think this was the late 90s when he had the situation in which inflation went up from 1.7 to 3.5%. Mortgage rates went from 7 to 8.5. And then so the Fed funds rate, he increased it 2% to be able to counteract that inflation. The response from inflation went down from 3.5 to 1%. Mortgage rates, once again, they came down from 8 to 5%. The consequence, once again, was recession. S&P went down 50%. more things go into recessions, but just understand that they do have a big lever on that being the Fed chair. And so right now in the situation that we have going on, we have Jerome Powell as the Fed chair, and inflation has gone up in the past couple of years from 1.5% to 8% right now, which is a big jump. Mortgage rates, as you're seeing right now, this is April 16, 2022, have gone up from roughly 2.5% to about 5% over the past 12 months. So the Fed, they've had their rate recently over the past couple of years at 0%, but they're planning to increase it a couple of percentage points over the next year or two. So what should this happen? This should cause inflation to drop. It should also cause the mortgage rates to drop at some point in time. We don't know if 5% is going to be the highest. It could potentially go as high as 6%, even higher than that. Experts had no idea it would even get to 5% right now. But whenever they start pulling that lever more and more, that'll end up causing the mortgage rates to come down a little bit. Consequence, most likely there's going to be a recession, which means that you're going to have to maneuver through that. But that's going to be the future of rates this year, is that most likely they're going to keep going up. But as soon as the Fed increases that Fed funds rate enough, whether that's this year, next year, rates will start going down. But for the time being, they're still on the rise up. Hope you have a great rest of your day. Thanks.